Here we go. 3, 2. Did you get your hand lotion? I just want to make sure you got your hand lotion.
My hands are.
Yeah.
This is for hands that are dry to extra dry.
Okay.
I fall in the
dry.
extra dry.
Right, good. I'm glad you're covered. Right, here we go. 3, 2. Did you moisturize that in? Have you got it all in your hands, Jack? You said.
Do you hear that? Is this
Yeah, I hear it.
mic?
All right, here we go. 3, 2. You sure you don't need one more pump? It seems like you need one more pump of that lotion, Jack.
It's all about the cuticles.
This is Nick.
This is Jack.
It's Thursday, the new Friday, March 16th, and today's pod is the best one yet.
It's a T-boy. Stocks dropped yesterday because over in Europe, they're dealing with their own financial crisis.
Not Silicon Valley Bank, but a situation with Credit Suisse, Swiss bank.
Credit Suisse in Swiss means Swiss bank, and its stock dropped 20% to a record low.
Okay, so Jack's and my portfolios, they're down. But today's pod is the best one yet. Jack, what's our first story for the show?
For our first story, sneakers that Michael Jordan wore in the 1998 NBA Finals, they're being auctioned off this month.
They're expected to sell for a record price, but even Air Jordan eventually comes down.
For our second story, yesterday we explained Silicon Valley Bank by quoting Biggie Smalls.
So today, we're going to explain the winner of Silicon Valley Bank's downfall by quoting Smokey the Bear.
And our third and final story is actor Ryan Reynolds. He just sold his wireless phone startup for $1.3 billion.
But this isn't about Ryan Reynolds' sultry smile. What is it about, Jack?
T-Mobile and its sultry stock.
It's got a very sultry stock.
But Yetis, before we hit that fantastic mix.
Absolutely wonderful mix for our second pod back. I love it.
What is the number one work perk you wish you had?
Free Greek yogurt, on-site dry cleaning, pet bereavement?
No, the ultimate perk isn't ultimate vacation either.
No, it's not.
It's an allowance.
More specifically, it's a pizza allowance.
Because get this, Yetis, the executives over at Domino's Pizzeria, they get $4,000 pizza allowance every year.
Yeti's CEO or CFO, meat lovers or margarita, they're getting a fresh pie.
Domino's execs get to devour Doms on corporate dime.
We did the math on this. $4,000 a year. That is 500 Domino's pizzas.
That's almost 3.14159 pies per day.
But that leads to the big question, Jack. Does the CEO of Domino's actually use this work perk?
I hope so. It'd be an insult if he didn't.
Well, according to the Financial Times, they do use that work perk. They use it a lot.
Last year, the CEO of Domino's spent $2,810 on Domino's pizza.
And the year before that, he spent $3,919 on Domino's pizza allowance.
But during the pandemic in 2020, the CEO dropped he expensed $6,126 on Domino's pies.
$6,000 on a pizza allowance? That's like 100 pizzas a day, man.
Pizza allowance. Isn't it the perk we all need?
You want a 4-day work week, or do you want a 5-day pizza party?
Look, guac's always extra. We know.
It is, but mozzarella, it shouldn't be.
We don't want Hawaiian shirt day.
No, we want Hawaiian pizza day, and we want it every day.
Let's hit our 3 stories. Come on.
15 years before this song, 2 boys from the Northeast met in the dorm. They had an idea that caused a cultural storm. It's the best one yet, but the best is the norm. Jack, Nick, that's it. I don't even think they need to practice. 50%, that's a fat tip. T-Boy City on your at list. If you know, you know, cause we ready to go. We can't wait no more, so just start the show.
For our first story, Michael Jordan's Last Dance sneakers are expected to sell for a record high price.
But the sneaker industry is shaped just like a Michael Jordan dunk.
Oh, Jack, let's go back to June 5th, 1998. Where were you? Because I know where I was.
I was probably listening to a Yankee game on the radio because in 1998, the Yankees won 114 games in the regular season.
I think I was playing with this Beanie Baby because that was around the time I got Bucky the Beaver Beanie Baby. I just remember being very excited to kick off the 98 summer with Bucky the Beanie Baby.
Well, if you were in Chi-Town, you probably watching the NBA Finals because Game 2 happened that day. The Chicago Bulls beat the Jazz of Utah 93-88.
And Michael Jordan threw up 37 points in that Chicago Bulls win.
After the game, according to multiple witnesses, Michael Jordan signed a pair of sneakers, the pair that he was wearing during the game, and gave them to the Utah Jazz ball boy.
And just a few games later, Michael Jordan would clinch his 6th and final NBA championship.
Now, Sotheby's has gotten their hands on those sneakers. I guess the ball boy's looking for some cash.
And they verified that Michael Jordan wore those sneakers, and that brings us to present day.
Sotheby's is putting them up for auction and expects them to sell for a record price for sneakers between $2 million and $4 million.
Okay, Yetis, it turns out Sotheby's is actually auctioning off 6 more pairs of Jordan sneakers these days.
More sweat, even higher price.
That patina is a profit puppy, Jack.
Because 2023 isn't the year of the rabbit. It's turning out to be the year of MJ.
Yeah, number 23 on his jersey. 2023 is becoming a big year for Michael Jordan memorabilia.
I see what you did there.
Now, Yetis, this is what Jack and I found so fascinating about this story. The sneaker market has quietly become the Cinderella story of luxury.
It's a surprise princess.
It's a surprise princess because collectible sneakers have become like their very own asset class.
You have equities, real estate, commodities, Converses.
So Sotheby's created a streetwear division back in 2019. And Jack, how's that streetwear division doing?
They sold $48 million worth of high-end sneakers.
Okay, let's look at StockX, the multi-billion-dollar online sneaker marketplace. They just had their best year ever in 2022.
And Sotheby's loves this market because sneakers opens up a new generation of customers to the world of auctions.
Get this, 80% of the sneaker buyers at Sotheby's auctions are first-time auction buyers.
So Sotheby's figures maybe sneakers are a gateway product.
Yeah, maybe you bid on the Pumas and then you end up bidding on the Picasso.
That's why Tiffany's just did a collaboration with Nike.
And that's why Gucci just partnered up with Adidas.
Yeah, a 17th century Rembrandt is nice, but it's not the only expensive store of value.
Yeah, younger collectors, they want art you can wear. And Mr. Rembrandt wouldn't appreciate being worn.
Nick, these are like NFTs, but physical.
Yeah, they are. So, Jack, what's the takeaway for our buddies over in the sneaker industry?
Just like a Michael Jordan dunk, all things return back to earth.
Yeti's reversion to the mean, a financial principle that no matter how much an asset class grows, eventually it returns to an average level.
Or, put another way, no matter how high Michael Jordan jumps, he eventually comes back to earth.
As exciting as the sneaker market has been to follow the last few years, it also has to come back down to earth.
And it has. In 2021, sales growth was 20%. But last year, that shrank to just 3% sales growth in the sneaker market.
Now, any growth in 2022 is good growth. And these Jordan sneakers, they're probably going to set a record price ever sold for a pair of sneakers.
But the industry is clearly maturing. Its growth is reverting to the mean.
Just like an MJ dunk, all markets eventually return to earth. For our second story, we're 1 week into the Silicon Valley bank crisis and one winner has emerged.
That one winner is the big banks.
It's the big banks.
That's exactly why we need to call Smokey the Bear.
Yetis, yesterday, Jack and I called upon the notorious BIG. We described the financial fire that was caused by Silicon Valley Bank's mistakes.
Now, fortunately, our institutions acted quickly to put out that fire over the weekend.
But as any FDNY fireman will tell you, when it comes to fires, what is the underlying rule, Jack?
Extinguishing a fire is great, but preventing the fire in the first place is better.
And that's why Jack and I think the next phase of the Silicon Valley bank crisis is going to focus on one thing.
That one thing is Smokey the Bear.
Smokey the Bear. Like, we need Smokey the Bear to prevent financial fires. That's who we need right now.
Only you, regulators, can prevent forest fires.
By the way, have you seen Smokey lately? He is big, burly, denim clad. He's looking better than ever.
He's got overalls, right?
It's like he's been doing the bench press for the last 50 years. It's incredibly impressive.
And yet he's still cuddly, isn't he?
It's a magnificent combination.
And he's getting a retainer with the federal government because the number one focus of policymakers right now is how to prevent the next Silicon Valley Bank financial fire.
Now, Yetis, if Smokey the Bear followed SVB, he would have rang the alarm over two major red flags. mistakes.
Two major fire risks that we all could have seen.
And the first of those fire risks that Smokey would have noticed is the mismanaged money.
Silicon Valley Bank invested in a huge portfolio of long-term government bonds that had low interest rates.
And Jack, why were those bad investments a fire risk?
Because when the Fed rose interest rates, the bonds lost a ton of value.
All right, so if the first fire risk was mismanaged money, the second Silicon Valley Bank fire risk was uninsured money.
A whopping 94% of the money that customers had in bank accounts were uninsured money.
Just to sprinkle on a little more context here, 94% of the cash at Silicon Valley Bank was just cash, unprotected, just sitting there.
94% was above the $250,000 FDIC limit.
And that made SVB vulnerable to a bank run just like dry forest tinder is vulnerable to a forest fire.
Both of those red flag risks are the results of Silicon Valley Bank management mistakes.
But honestly, they were red flags that regulators could have and should have noticed.
That's why the next phase is Smokey the Bear. How do we prevent this in the future?
Because only Jack can whip up a takeaway for us. So Jack, what's the takeaway for our buddies in the U.S. financial system?
If nothing changes after Silicon Valley Bank, then a big bank monopoly will grow.
Okay, so Yetis, the biggest winner of Silicon Valley Bank's downfall so far, it's Bank of America. Like while SVB fell, Bank of America was surging.
According to Bloomberg, in just the past 72 hours, $15 billion of new money went into Bank of America checking accounts.
That is a huge influx of new business, Jack.
And why is everybody going to Bank of America?
Because confidence in smaller banks is shaken, so people are flocking to the safety of the biggest banks.
Silicon Valley Bank showed us that money is only safe up to the $250,000 FDIC limit.
Honestly, beyond that, your cash is only as strong as your bank is.
So regulators have to convince us all that our money is safe, even at smaller and regional banks too.
And to do that, they're going to need new rules to prevent fires before they happen.
Because if nothing changes after Silicon Valley Bank, then a big bank monopoly is going to grow. And now a word from our sponsor, Robinhood.
Would you like more? More hand cream, more french fries? Jack, would you like more weekends?
Would you like 18 times more of all those things?
Well, if you sign up for Robinhood Gold for $5 a month, your uninvested cash grows by 4.15% per year.
That's 18 times more than the average bank savings account rate, according to Bankrate as of January 25th, 2023. Terms apply.
With 4.15% APY, your uninvested cash literally grows. Like you can still use your cash anytime for anything.
Then spend that extra cash on 18 times more french fries.
To get started, go to Robinhood.com/TBoy and get your first stock for free.
That's Robinhood.com/TBOY.
Certain limitations apply. Rate is subject to change. All investments involve risk.
Robinhood Financial LLC, member SIPC. Robinhood is not a bank.
For our third and final story, actor Ryan Reynolds just sold his wireless company Mint for $1.3 billion to T-Mobile.
Out of nowhere, T-Mobile has gone from the number 3 to number 1 wireless company in America.
Okay, but first, Jack, we got to talk about potential Yeti Ryan Reynolds.
He has transformed from a PG actor to a VC investor.
Okay, Jack, can we talk about the resume? I'm sorry, can we look at his IMDb, please?
This Canadian-born actor, this 2-time Teen Choice Award winner, used to be in the friend zone.
But now Ryan Reynolds is the Ben Horowitz of Hollywood.
Ryan Reynolds is the Sequoia capital of celebrities.
Ryan Reynolds is the Mark Andreessen of actors.
He has invested and sold so many companies we're struggling to keep track.
Can we say the Warren Buffett of blockbusters, Jack?
Sure.
How about the Massa of movies?
Yes.
I actually ran out at this point. Yet Ryan Reynolds sold his gin company to Diageo in 2020 for $600 million.
Ryan Reynolds decided to film a documentary about buying a Welsh soccer club, and then he sold that documentary to Disney.
Ryan Reynolds also owns 25% of Mint Mobile, a low-priced wireless company.
And yesterday, Ryan Reynolds sold that wireless startup to T-Mobile for a clean $1.35 billion.
Not too shabby. Probably beats that payday from the first Van Wilder movie. Now, Yetis, this whole story Jack and I began telling you, it started with the wrinkle-free face of Ryan Reynolds.
But it ends with T-Mobile.
So Jack and we jumped in T-Boy style, and we noticed that T-Mobile stock has more than doubled in the past 5 years.
How about T-Mobile's much bigger, much stronger competition, AT&T and Verizon?
Well, I'm glad you asked, Jack. AT&T and Verizon, their shares have actually fallen over that same period of time.
T-Mobile was always a distant number 3 wireless carrier in the United States.
I love the pink. It's almost Slam and Salmon, but they were number 3 in the United States.
But now T-Mobile stock is a clear number 1.
Yeah, and in the past 5 years, T-Mobile has added 35 million net new phone plans. AT&T would be jealous.
How has T-Mobile added 35 million net new phone plans in the past 5 years, Nick?
Well, here's the funny thing, Jack. They didn't raise prices despite inflation.
They weren't allowed to raise prices despite inflation.
That's the shocker. They were forbidden, they were verboten, they were niched from raising prices.
That's a niche.
Takeaway? Ach yeah. So Jack, what's the takeaway for our buddies over at T-Mobile?
T-Mobile is grounded. And that is the best thing that's ever happened to it.
Hey, Yetis, you know one way that T-Mobile got so big? It was by merging with Sprint.
The other way T-Mobile got so big was by getting grounded.
Here was the surprise. To get approval for that Sprint merger, T-Mobile had to agree to not raise prices for 5 years.
The government grounded T-Mobile as a condition to let it buy its rival Sprint.
So literally for 5 years, Verizon and AT&T, they've been nickel and diming us customers just like you'd expect.
Meanwhile, T-Mobile has kept the price the same. They literally weren't allowed to nickel and dime us customers.
So like with no option to raise prices, T-Mobile had to focus on serving customers. And you know what? It worked.
Until 2025, T-Mobile, you're grounded.
But that is the best thing that has ever happened to T-Mobile. Jack, can you and that hand lotion whip up the takeaways for us over there?
Michael Jordan sneakers from his Last Dance NBA Finals are going to auction.
Like a Michael Jordan dunk, all markets, including sneakers, come back down to earth.
For our second story, the winner of Silicon Valley Bank so far is the biggest American banks.
And if nothing changes after this crisis, it'll lead to a big bank monopoly.
And our third and final story, Ryan Reynolds has sold another company, this time Mint Mobile to T-Mobile.
T-Mobile, it is still grounded. And honestly, the best thing that's ever happened to it. Now, time for the best fact yet. This one sent in by legendary Yeti Boone Boozley in Idaho Falls, Idaho.
Push and play.
Here we go.
Did you know that Bob Ross's hair is not actually curly? In fact, it is straight. As he started his show, he had tried out a perm, and it was so successful in helping identify who he was that he kept it for the rest of his career. Even as he lost his hair, he had a wig made to match that same hairstyle that we know and love. It goes to show that branding is everything.
Did I see you stroking your perm over there, Nick?
I was. This is quite a situation I got on over here.
Bob Ross's perm, though, it's the perfect spherical shape of a basketball. It's meticulous like his paintings.
When you divide the circumference of Bob Ross's hair by the diameter, I think you get
3.14159 Domino's pizzas.
The perfect number for a pizza pie allowance. Yetis, you look fantastic today. Jack, you're doing amazingly despite like 3 hours of sleep. Honestly, you're crushing it over there.
The bassinet really blew it last night.
Yetis, if you want to help Jack get some sleep and help grow our pod, the best thing you can do is ask HYHTBOY.
Have you had the best one yet? It's how we grow by word of mouth with your friends being our friends.
If you know, you know. And before we go, a shout out to Yeti Manish Parikh, who has been listening to this podcast for 3 straight years. Thank you, Manish.
And congratulations to Glenn and Lydia Rettel, who just got married in San Antonio, Texas.
And a happy birthday to the twins Maya and Mia Garcia, who are turning 1 year old over in Paterson, New Jersey.
And happy 34th birthday to Jessica Starr in Vallejo, California.
And Talia Hill is celebrating that birthday down at South by Southwest.
And happy birthday to Mila Slabiak in Colts Neck, New Jersey.
And Taylor Ann Poplar McTropolis has got a birthday that she's celebrating over in Boston. And where is that, Jack?
Just outside of Boston.
Just outside Boston.
And to anyone else celebrating something today, make it a T-Boy.
Celebrate the wins.
This is Jack. Nick and I both own stock of Robinhood, and my son Wilder wasn't totally named after Van Wilder, but there might have been some influence there. And now a word from our sponsor, Robinhood.
The beauty of American finance, it's that your money works for you.
If you have cash sitting in an account, the financial institution should pay you for it.
Yeah, but not all do. Like some accounts won't pay you anything for your cash.
Robinhood will pay you for your uninvested cash.
In fact, with Robinhood Gold, your money will work hard for you, generating 4.15% APY, one of the highest rates.
For $5 a month, Robinhood Gold sets no limit on how much cash you can put in, and you can invest or withdraw anytime. Terms apply.
To get started, go to Robinhood.com/TBoy and get your first free stock.
That's Robinhood.com/TBOY.
Certain limitations apply. Rate is subject to change. All investments involve risk.
Robinhood Financial LLC, member SIPC. Robinhood is not a bank. What's Rembrandt's first name?
Larry.